if you've ever been in a situation where, let's say you're very clear on your higher time frame direction, you've knocked out your key levels, and for some reason, the moment you go into the lower time frames and like every little move just causes you to change your bias and you just get completely lost in the noise. You start ping-ponging around, like you start taking a long when the lower time frame says long, you start taking a short when the lower time frame starts breaking down, when in reality the whole time you had a clear idea of like where price is ultimately going to go, but then just you get lost in the lower time frame noise. So if you've been in a situation like that, this video is probably going to help you. So this was inspired by, like, I just did a backtest review for one of our clients here in bootcamp. Basically in here, like we get everyone to review, like to basically just backtest live, and I'll be the one to personally go through the backtest and like, hey, this is what you're doing right, this is what you're doing wrong, and stuff like that. So one of the things I noticed with, one of the things I noticed with Ave is, granted, this is his first ever backtest review, so he's bound to make some, slightly more rookie mistakes, is that he had a situation where, for example, the daily time frame is bullish. He marked it out already. On the hourly time frame, he's marked out the fair value gaps and order blocks that he wanted to take advantage of when price gets there. But the moment he hops down into the 5-minute, boom, price breaks structure towards the downside. And then, oh my God, damn, this is looking bullish. Sorry, this is looking bearish now. So he ends up taking a short, and it loses almost immediately, just for price to completely reverse in the other direction and go in the way that he already anticipated. Like he already was able to read the higher time frame stuff. It's just the moment he went into the lower time frames, he got lost in the noise. So what do you do in this situation? Well, the advice that I gave him was 2 things. 1, always let your higher time frame be the guide, in the sense that, you know how you've heard the saying before, the higher the time frame, the stronger the move, or like the more conviction that you should have with the move. And that is generally true, although not for the reasons that people tend to say. I'm not going to get into that for now, but just understand that if your system has, anywhere between 2 to 3 time frames, whatever the direction, right, you use your higher time frame for direction, which means, let's say you are trading on the H4 and the H1. So if the H4 tells you that it's bullish, and if you're anticipating H4 to be bullish, you're going to disregard any bearish moves that happen on the 1 hourly chart, because your higher time frame is pointing up, right? Let it be the guide. Let it be the compass. And so you understand that whatever moves that go down from, the 1 hourly is just a opportunity for you to buy lower, or like take advantage of some kind of downside manipulation, so that you can ride the higher time frame move up. Now, you've seen this a lot with a lot of the daily videos I've done, where prior to, like, I'd say if I'm bullish for the day, you get a lot of like bearish moves to trick people into thinking like, hey, the market's going to go down. But in reality, it eventually shoots straight up on a certain session. Why is that the case? It's because the higher time frame tells you direction. You always want to take the higher time frame as direction. So I'm going to run you through just a little concept here. Bear with me. This is not the most ideal. This is not the most ideal situation for you to be drawing. But essentially, if you are bullish for the day, let's say, like this is where price opens up, what you're going to want to look for is for price to actually sweep below, right, in a false move before ultimately expanding to the upside. And I'm using this from a daily perspective, but you can apply this to any time frame. Essentially, what this means is that initial move, if you get a fake out towards the downside, you don't want to be tracked into that lower time frame noise. As long as your higher time frame tells you that, hey, it's going to be a bullish day, this is actually an opportunity for you to take advantage of buying low and then selling high. And of course, like, I think one of the other reasons why, and of course, like, feel free to just apply that to the bearish direction. If you're bearish, obviously take the opportunity to sell high, and then, allow people to buy lower. That's how you make money. And the second piece of advice is, a lot of the times, and this is going to kind of reflect back to the first piece of advice, which is not reasoning from the bottom up. Again, I've already kind of taught you that, you want to let the higher time frame be your guide, but more than that, another issue that he made was he had a lot of theories about how the lower time frame was going to play out. So, for example, based on how the Asia session is playing out, the London session is playing out, he was like, okay, this is definitely going to be an AMD. And in getting caught up with the lower time frame moves, he just completely lost sight of the fact that the higher time frame was bullish. And so this is a prime example of a situation where he was trading what he thought was going to happen rather than what the market is actually showing. And this is oftentimes easier said than done, but you just want to keep in mind the way you kind of like mitigate this issue completely is just use the higher time frame as your guide. Usually what we do inside bootcamp, or at least the way that I teach the system, which, you know, a lot of people have found success with, is you want to have 3 high frames. You want to have a higher time frame. In my case, it's a daily chart. You've seen this in the videos. And you have a middle time frame, which is the 1 hourly, and the lower time frame, which is the M5. So the daily chart is purely, like your higher time frame, is purely just for direction, meaning whether today's price is gonna be more likely to go up or down. That's it. That's the entire context of that time frame. Your H1 is where you find key levels that align with your higher time frame direction. Meaning, if your daily is bullish, you use the middle time frame to find bullish PD arrays, meaning fair value gaps, order blocks, or even liquidity sweeps that you can take advantage of in line with the higher time frame direction. It also means that if my higher time frame is bullish, I am not looking for bearish PD arrays or bearish key levels on my middle time frame. Just bullish, because again, you want to let the higher time frame be your guide. You want to let that be your compass. That should determine everything else that you do that trickles down, right? This is called top-down analysis. And then your M5 is used for when price eventually gets into the key levels that you've marked out on your 1 hourly chart, and you hop into the lower time frame and you start looking for, let's say, if your overall direction is bullish, with a bullish context so far, then you wait for the 5-minute chart to show some kind of bullish change in structure, changing order flow, whatever it might be. Once that happens, you're going to be getting into trades where everything is aligned. And doing so will help you prevent all of the confusion. But if you keep finding that you get lost in the noise, utilize this, and I think you're going to find great success. Let me know if this helps in the comment section down below. And yeah, I'm going to get back to doing more backtest reviews because I've got a few that I have to go through today.